much for joining. This session is an introduction to risk and types of risk. It's quite important, especially when we talk about capital structure and the calculation of cost of capital, weighted average cost of capital. I want to ensure that you are clear what we mean by risk in finance. You may have heard risk and return. The higher the risk, the higher the return is. You expect, if you invest in a risky asset, you would expect a higher return. If you invest in a not so risky asset or portfolio, then you would assume the return is lower. Good. What does it mean? Return, I will cover this in another video. When we talk about risk, let's assume company A. The A has an average return of 20%. So if you invest in the company, again, we can do the same for portfolio, which I will discuss in another video. Average return of 20%. And has a specific risk. So 20% average or expected return. And then what is happening? The curve goes like this. Yeah, so this is 20% return. And then it can be higher or it can be lower. Yeah, standard deviation. You may have seen this curve normal distribution. So here we have 25%, here we have 15%, and so on and so forth. So what we mean by expected return, we mean basically the midpoint of this normal distribution, but it can be higher and it can be lower. And when we talk about risk in finance, we talk about this one. We talk about the width of a normal distribution. Width of normal distribution. And this is measured in standard deviation. Yeah, just to recap, we don't need to go into the standard deviation of R, your return, or your variance of return. And then you may have heard 2 standard deviation, 1 standard deviation, and so on. The greater the width of this normal distribution, the more volatile and the greater the risk. So the greater the standard deviation, the more variation is there, positive and negative, the more volatile and the higher the risk. Yeah. So risk always usually sounds negative, but here when we look at this, we don't look at negative or positive, we look at volatility. Yeah, left and right. If we have another asset, let's say we invest in another company. The other company has, let's say, an expected return of 20% as well. But let's assume the normal distribution goes like this. Yeah, we also have 20% expected return, but we can see that the standard deviation is way lower. Yeah, so here maybe in blue the standard deviation could be 20%, and here our initial case, the standard deviation could be something like, I don't know, 40%. Yeah, standard deviation variance is basically the same, for sure not from mathematical perspective, but if we talk finance, I would urge you to look at and use standard deviation, because the unit is in percentage, and the magnitude is also more similar to our return figure. Variance would be a different magnitude, would be percentage squared, which would give you a very small number with a lot of zeros in decimals. So use standard deviation and look at risk more from a volatility perspective. Yeah. Types of risk. In finance, there are different types of risk, and it's quite important to be very clear what we mean. Because when it comes to portfolio management, cost of capital, there's only one type we are really interested in. So a few types of risk. We have unsystematic risk. We have diversifiable risk. We have unique risk. We have firm-specific risk. We have what else? Idiosyncratic risk. We also have systematic risk, market risk, non-diversifiable risk, and non-idiosyncratic risk. And what is important is these are risks that affect all companies. And these are risks that affect individual companies. Yeah, so affect individual companies is change of CEO, product issues, you build a new production line, you expand into another country, you have invested in a new IT system, very specific. You see here firm specific, individual. This affects a single factory. If there's a production plan fire, product launch that goes well or that didn't go well, it's very related to individual companies. Whereas here, systematic risk, market risk, this is change in market interest rate, inflation, COVID, geopolitical issues, and so on. Earthquakes, natural disasters that affect basically all companies. In finance, when we talk about risk and return, we are not concerned with those risks because you are not compensated. If you invest in this company A that has, let's say, a bad CEO, and you are saying, hey, whenever I invest in this company, I have more unique risk, I have more firm-specific risk. That's why I should receive a higher return, because as you know, higher risk, higher return. Then the concept says, no, you are not getting compensated for taking on these types of risks because they are all diversifiable. If you hold a large enough portfolio of assets, like companies, shares, fixed income instruments, those specific risks cancel each other out. Sometimes you win, sometimes you lose, but you are not getting a higher return if you take on those risks because they are diversifiable. So all the risks that we are interested in from a valuation capital structure perspective are those risks because they are non-diversifiable. You can't get rid of them. The risks we talked here, standard deviation, is a mixed standard deviation, measures total risk, standard deviation. We are not using standard deviation for calculations. We are only using a figure that covers our systematic risk, which is our beta, which I will explain in another video. So very important, risk means volatility. There are two broad types of risks. One is diversifiable / firm specific risk. The other type of risk is systematic risk. Total risk, that includes both, is measured with standard deviation, whereas, and I will come to this especially when we look at weighted average cost of capital, systematic risk is captured by our beta. Thank you so much for listening. Talk to you later.